Welcome to The Man from Macro, where we look at some of the big themes in today's global markets. This week, we look at why the US economy may be about to reaccelerate, how policymakers might react, and what that means for markets. So let's have a look at a couple of data points. First up is the ISM survey. The manufacturing index is still in contraction territory, below 50, but it continues to rebound off the lows and is now at its highest levels since late 2022. This could soon cross back into expansion territory. If it does, this will be one of the longest periods with the index below 50, without incurring an official recession. Meanwhile, the ISM non-manufacturing index is well above contraction territory at 53.4. But it's the prices paid element which has seen a significant bounce. This now stands at 64, which, excluding the post-COVID surge, is one of the highest levels in over a decade. The non-manufacturing service sector accounts for about 80% of the US economy. Jim Bianco points out that services CPI ex-energy accounts for 3.09% of the current 3.4% of headline CPI. Therefore, a rebound in non-manufacturing prices paid implies that the services CPI will continue to support inflation, making it increasingly difficult for policymakers to reach their 2% target. Our second data point is the US Senior Loan Officers Survey. The number of large and medium-sized firms reporting tighter standards has started to fall, whilst the number reporting an increase in demand for loans has been increasing. It is historically unusual for conditions to have been this tight, for this long, without an official recession. If conditions are now improving, the economy might be able to start motoring again. An expanding economy should normally be considered a good thing, but it could also impact the prospects for looser policy that has helped risk assets in recent months. Meanwhile, the market narrative continues to bounce between two base camps. One camp expects the economy to roll over into an organic slowdown and recession. Typically, this would involve a surge in unemployment, but this has not yet materialized. The second camp expects the economy to remain resilient, thus requiring hawkish activity from either the Federal Reserve or the bond market to eventually cap inflation. The recent data has given this camp a boost. The Fed funds curve is still implying about 100 basis points of cuts by the end of the year. The implied rate is loosely calculated as 100 minus the futures levels. But what happens if both the manufacturing and non-manufacturing ISM are in expansion territory at the point where markets were expecting the first rate cuts to materialize? If the US equity market is still near the all-time highs and the unemployment rate is hovering around 4%, then what's the incentive for policymakers to start cutting rates? Over the last 2 years, we have not yet experienced a coordinated slowdown across the economy. It's been a piecemeal, stop-start affair. And this could be the saving grace. Unemployment could stay optically tight, even if the jobs market is not strong. Inflation can therefore remain above the target rate, but not so far above that it causes a policy panic. But that's a very fine tightrope. If the biggest boost to equity markets over the last 6 months was the repricing of rates to a lower level, then equities could be vulnerable to the market unwinding those expectations in 2024. Alternatively, if the market wants the Fed to cut, it needs to incentivize them. That could require a lower equity market for the Fed to pull the trigger. Either way, a reacceleration of the economy could be more of a threat than a benefit to risk assets from here. That said, please remember, none of this is investment advice. These are just observations for educational purposes only, and everyone should be aware of their own investment objectives and risk profiles. But thanks for watching.